Question 1. The review process indicates that a new digital lending product is being considered for launch. What is the most appropriate approach to assess its potential impact on the market and Sberbank's operations? Option A. Prioritize the assessment based solely on the projected revenue generation and market share gains, assuming minimal impact on existing customer segments. Option B. Conduct a comprehensive assessment evaluating market disruption, customer data implications, operational risks, and regulatory compliance, involving cross-functional teams and potentially external expert consultation. Option C. Delegate the entire impact assessment responsibility to the product development team, trusting their judgment on potential challenges. Option D. Rely primarily on the success metrics of a previously launched but dissimilar digital product, assuming similar market reception and risk profiles. Correct answer is B. Conduct a comprehensive assessment evaluating market disruption, customer data implications, operational risks, and regulatory compliance, involving cross-functional teams and potentially external expert consultation. Explanation. Scenario analysis. This scenario presents a professional challenge by requiring the assessment of a new product's potential impact on existing market structures and customer behavior within the Sberbank operating environment. The challenge lies in anticipating unintended consequences and ensuring compliance with evolving financial regulations, which often lag behind technological innovation. A thorough impact assessment is crucial to mitigate risks, maintain market integrity, and uphold customer trust. Correct approach analysis. The correct approach involves a comprehensive, multifaceted analysis that considers both quantitative and qualitative factors. This includes evaluating the product's potential to disrupt existing competitive dynamics, its implications for customer data privacy and security, and its alignment with Sberbank's strategic objectives and risk appetite. Furthermore, it necessitates proactive engagement with relevant internal stakeholders, e.g., compliance, risk management, IT security, and potentially external regulatory bodies to ensure all potential impacts are understood and addressed. This aligns with best professional practice by prioritizing a holistic and forward-looking risk management strategy, which is implicitly supported by general principles of prudent financial management and regulatory expectations for responsible innovation within the financial sector. Incorrect approaches analysis. One incorrect approach focuses solely on the immediate revenue potential of the new product, neglecting broader market and customer impacts. This is professionally unacceptable, as it demonstrates a failure to conduct a thorough risk assessment, potentially leading to unforeseen regulatory scrutiny, reputational damage, and long-term financial losses due to market backlash or noncompliance. It violates the ethical principle of acting in the best interest of the institution and its customers by prioritizing short-term gains over sustainable growth and stability. Another incorrect approach involves relying exclusively on historical data from similar, but not identical, product launches. While historical data can be informative, it fails to account for the unique characteristics of the new product and the dynamic nature of the current market and regulatory landscape. This can lead to an underestimation of risks and an overestimation of benefits, resulting in a flawed impact assessment and potentially non-compliant product rollout. This approach exhibits a lack of critical thinking and an insufficient understanding of the need for context-specific analysis. A third incorrect approach is to defer the impact assessment to the product development team without independent oversight. This creates a conflict of interest, as the development team may be biased towards highlighting positive aspects and downplaying potential negative consequences. It bypasses essential checks and balances, increasing the likelihood of overlooking critical risks and failing to meet regulatory requirements for independent risk evaluation. This approach undermines the principles of good corporate governance and internal control. Professional reasoning. Professionals should adopt a structured and comprehensive approach to impact assessment. This involves defining clear objectives for the assessment, identifying all relevant stakeholders, gathering data from diverse sources, employing appropriate analytical tools, both quantitative and qualitative, and documenting findings and recommendations thoroughly. A critical element is the establishment of an independent review process to ensure objectivity and thoroughness. Professionals should always consider the potential for unintended consequences and proactively seek to mitigate risks, aligning their actions with both regulatory expectations and ethical obligations to protect the institution and its customers. Question 2. The analysis reveals that a Sberbank employee receives an informal request from a colleague in another department to access a specific client's recent transaction history to understand their spending patterns. The employee has the technical capability to access this information directly through the internal banking system. What is the most appropriate course of action for the Sberbank employee? Option A. Politely decline the request, explaining that access to client transaction history requires a formal, documented business justification and proper authorization according to Sberbank's internal policies and relevant Russian Federation regulations. Option B. Access the client's transaction history and forward it to the colleague's personal email for their convenience. Option C. Access the client's transaction history and save it to a shared network drive for the colleague to retrieve later. Option D. Immediately access the client's transaction history and provide it to the colleague, assuming the colleague has a valid reason for the request. The correct answer is A. Politely decline the request, explaining that access to client transaction history requires a formal, documented business justification and proper authorization according to Sberbank's internal policies and relevant Russian Federation regulations. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the immediate need for information with the long-term implications of data handling and client confidentiality. The Sberbank employee must navigate the potential for both legitimate business needs and the risk of unauthorized access or misuse of sensitive client data, all within the strict confines of Sberbank's internal policies and relevant Russian Federation regulations governing financial institutions and data protection. Correct approach analysis. The correct approach involves a formal, documented request that clearly articulates the business justification for accessing the client's transaction history. This aligns with best professional practice by ensuring transparency, accountability, and adherence to Sberbank's internal control framework and the principles of data minimization and purpose limitation mandated by Russian data protection laws, e.g., Federal Law No. 152 FZ on personal data. Such a process allows for proper oversight, risk assessment, and authorization, safeguarding client confidentiality and preventing potential regulatory breaches. Incorrect approaches analysis. Accessing the client's transaction history without a documented business need or proper authorization constitutes a serious breach of client confidentiality and Sberbank's internal policies. This could violate Article 26 of the Federal Law on Banks and Banking Activities, which protects banking secrecy. It also fails to adhere to the principle of lawful processing of personal data, as outlined in Federal Law No. 152 FZ, which requires a legitimate basis for data access. Sharing the client's transaction history with a colleague without a clear, documented business need and appropriate authorization is also a violation. This bypasses established internal controls and could lead to unauthorized disclosure of sensitive financial information, potentially contravening both internal Sberbank procedures and the aforementioned Russian federal laws regarding banking secrecy and personal data protection. Forwarding the client's transaction history to an external email address, even for a seemingly benign purpose like safekeeping, is a severe regulatory and ethical failure. This action significantly increases the risk of data breaches, unauthorized access, and misuse of sensitive client information. It directly violates data security protocols and likely contravenes provisions of Federal Law No. 152 FZ concerning the cross-border transfer and security of personal data, as well as Sberbank's stringent policies on information security. Professional reasoning. Professionals in the financial sector must always prioritize adherence to regulatory frameworks and internal policies. When faced with a request for sensitive client information, the decision-making process should involve 1. Identifying the specific regulatory requirements and internal policies applicable to the data in question. 2. Assessing the legitimacy and necessity of the request based on a defined business purpose. 3. Following the established, documented procedures for data access and authorization. 4. Ensuring that any data accessed is handled with the utmost confidentiality and security. 5. Documenting all actions taken for audit and accountability purposes. This systematic approach minimizes risks, maintains client trust, and ensures compliance with legal and ethical obligations. Question 3. Quality control measures reveal that a new digital banking product is being fast-tracked for launch with only a cursory review of its potential impact on customer data privacy and compliance with existing anti-money laundering (AML) regulations. The development team argues that a detailed impact assessment would significantly delay the product's market entry, potentially allowing competitors to gain an advantage. Which of the following approaches best represents the professional and regulatory obligation in this situation? Option A. Conduct a limited impact assessment focusing only on the most obvious data privacy concerns, assuming that AML compliance is adequately covered by existing general bank policies. Option B. Authorize the launch based on the development team's assurance that the product is compliant, with the understanding that any regulatory issues will be addressed reactively if they emerge. Option C. Immediately halt the product launch and initiate a comprehensive impact assessment that thoroughly evaluates all potential risks to customer data privacy, AML compliance, and overall market integrity, engaging relevant compliance and legal departments. Option D. Proceed with the launch as planned, but instruct the compliance department to conduct a post-launch review to identify and address any issues that may arise. The correct answer is C. Immediately halt the product launch and initiate a comprehensive impact assessment that thoroughly evaluates all potential risks to customer data privacy, AML compliance, and overall market integrity, engaging relevant compliance and legal departments. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between the need for timely product development and the imperative to conduct thorough impact assessments as mandated by regulatory frameworks. The pressure to launch new financial products quickly can lead to a temptation to shortcut or minimize the impact assessment process, potentially exposing the institution and its clients to unforeseen risks. Careful judgment is required to balance innovation with robust risk management and regulatory compliance. Correct approach analysis. The correct approach involves a systematic and comprehensive impact assessment that considers all relevant regulatory requirements, potential risks to clients and the market, and the operational feasibility of the new product. This aligns with the principles of responsible innovation and prudential regulation, which emphasize proactive risk identification and mitigation. By thoroughly evaluating the potential consequences, the institution demonstrates adherence to its duty of care and its obligations under relevant financial regulations, ensuring that new products are not only profitable but also safe and compliant. This approach fosters trust with regulators and clients. Incorrect approaches analysis. One incorrect approach would be to proceed with the launch without a formal impact assessment, relying solely on the development team's internal review. This fails to meet regulatory expectations for due diligence and risk management. It represents a significant ethical and regulatory failure, as it bypasses established procedures designed to protect consumers and maintain market integrity. Such an omission could lead to severe penalties, reputational damage, and potential financial losses if unforeseen issues arise. Another incorrect approach would be to conduct a superficial impact assessment that only addresses the most obvious risks, neglecting potential downstream or indirect consequences. This approach, while appearing to satisfy a procedural requirement, is fundamentally flawed. It demonstrates a lack of diligence and a disregard for the comprehensive nature of regulatory requirements. Ethically, it is a failure to act in the best interests of clients and the market. Regulatorily, it is likely to be viewed as non-compliance, as the assessment would not have adequately identified and mitigated all material risks. A third incorrect approach would be to delay the impact assessment until after the product has been launched, intending to address any issues that emerge. This is a reactive and highly irresponsible strategy. It directly contravenes the proactive risk management principles embedded in financial regulations. Ethically, it prioritizes immediate commercial gain over client safety and market stability. Regulatorily, it is a clear violation, as impact assessments are designed to be a pre-launch safeguard, not a post-launch remediation tool. Professional reasoning. Professionals should adopt a structured decision-making process that prioritizes regulatory compliance and ethical conduct. This involves 1. Understanding the specific regulatory requirements applicable to the product and jurisdiction. 2. Identifying all potential stakeholders and the impact on each. 3. Conducting a thorough risk assessment including operational, financial, legal, and reputational risks. 4. Documenting the assessment process and findings meticulously. 5. seeking appropriate internal and external expertise where necessary. 6. Ensuring that any identified risks are adequately mitigated before product launch. 7. Establishing ongoing monitoring mechanisms post-launch. This systematic approach ensures that decisions are informed, defensible, and aligned with the highest professional standards. Question 4. Market research demonstrates a significant appetite for a new, complex investment product designed for retail clients. The product offers potentially high returns, but also carries substantial risks, including the possibility of total capital loss. The product development team is eager to launch quickly to capture first-mover advantage. Which approach to assessing the impact of this new product is most aligned with regulatory expectations and professional best practices within the Sberbank operational framework? Option A. Prioritize the product's potential profitability and market demand, as indicated by initial research, and proceed with a swift launch to capitalize on the identified opportunity. Option B. Delegate the entire impact assessment process to the product development team, trusting their expertise and understanding of the product's features and benefits. Option C. Rely on informal discussions with a few experienced sales managers and the product development team to gauge potential client reactions and market acceptance. Option D. Conduct a thorough, documented impact assessment that considers potential effects on all client segments, market stability, operational risks, and compliance with relevant CIS financial regulations, with independent review of findings. The correct answer is D. Conduct a thorough, documented impact assessment that considers potential effects on all client segments, market stability, operational risks, and compliance with relevant CIS financial regulations, with independent review of findings. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the potential benefits of a new product launch with the imperative to comply with Sberbank's internal risk management policies and relevant regulatory guidelines. The pressure to innovate and capture market share can sometimes lead to overlooking potential negative impacts, making a thorough and objective impact assessment crucial. The challenge lies in identifying all relevant stakeholders, anticipating unforeseen consequences, and ensuring that the assessment is comprehensive and not biased by commercial objectives. Correct approach analysis. The correct approach involves a systematic and documented process of identifying, analyzing, and evaluating the potential impacts of the new investment product on various stakeholders and the broader market. This aligns with best professional practice and regulatory expectations for responsible product development and deployment. Specifically, it adheres to the principles of client protection, market integrity, and sound risk management, which are fundamental to financial services regulation in the CIS jurisdiction relevant to Sberbank. A robust impact assessment ensures that potential adverse effects are understood and mitigated before launch, thereby safeguarding client interests and maintaining market stability. Incorrect approaches analysis. One incorrect approach focuses solely on the potential profitability and market demand, neglecting to consider the broader implications. This represents a significant regulatory and ethical failure, as it prioritizes commercial gain over client well-being and market stability. Such an approach could lead to the introduction of products that are unsuitable for certain client segments, potentially causing financial harm and reputational damage, and violating principles of fair dealing and due diligence expected by CIS financial regulators. Another incorrect approach involves relying on anecdotal evidence and informal feedback from a limited group of internal stakeholders. This is professionally unacceptable because it lacks the rigor and objectivity required for a comprehensive impact assessment. It fails to capture the diverse perspectives of all affected parties and may overlook systemic risks or unintended consequences. This approach is ethically questionable, as it bypasses established procedures designed to ensure responsible product introduction, and could lead to regulatory breaches related to inadequate risk assessment and control frameworks. A third incorrect approach is to delegate the entire impact assessment to the product development team without independent oversight. This creates a conflict of interest and undermines the objectivity of the assessment. The product development team may be biased towards a positive outcome, potentially downplaying or ignoring negative impacts. This failure to ensure independent review is a breach of good governance and risk management principles, which are often mandated by regulatory bodies to ensure that decisions are made with a balanced perspective and that potential risks are thoroughly scrutinized. Professional reasoning. Professionals should adopt a structured, multi-stakeholder approach to impact assessment. This involves defining clear objectives for the assessment, identifying all relevant internal and external stakeholders, gathering data from diverse sources, employing appropriate analytical tools, and documenting findings transparently. Independent review and validation of the assessment are critical to ensure objectivity and compliance. Professionals should always prioritize adherence to regulatory requirements and ethical principles, ensuring that client interests and market integrity are paramount in all decision-making processes. Question 5. During the evaluation of a client's recent trading activity, an employee of Sberbank observes a pattern that, while not definitively illegal, raises concerns about potential market manipulation. The employee has a strong professional relationship with the client and is hesitant to jeopardize this relationship or cause undue alarm. The employee is aware of Sberbank's internal policies regarding the reporting of suspicious transactions and the relevant regulatory requirements for preventing market abuse. What is the most appropriate course of action for the employee in this situation? Option A. Ignore the trading pattern as there is no concrete evidence of wrongdoing and avoid any action that might upset the client. Option B. Directly confront the client with the suspicions and ask for an explanation of their trading strategy. Option C. Discuss the trading pattern and suspicions with trusted colleagues in other departments to gather their opinions before deciding on a course of action. Option D. Discreetly report the observed trading pattern and the associated concerns to the Sberbank Compliance Department for further investigation. The correct answer is D. Discreetly report the observed trading pattern and the associated concerns to the Sberbank Compliance Department for further investigation. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential market abuse. The employee must navigate the delicate balance of protecting client information while upholding regulatory integrity and preventing harm to the market. The pressure to maintain client relationships and avoid potential repercussions for reporting can complicate decision-making. Correct approach analysis. The correct approach involves discreetly escalating the suspicion to the compliance department without directly confronting the client or revealing the specific nature of the suspicion. This aligns with the regulatory framework of Sberbank, which mandates reporting of suspicious activities to prevent market manipulation and insider trading. The compliance department is equipped to conduct a thorough investigation, gather necessary evidence, and take appropriate action in accordance with relevant laws and internal policies, thereby safeguarding both client interests and market integrity. This method upholds the principle of innocent until proven guilty for the client while fulfilling the professional duty to report. Incorrect approach is analysis. One incorrect approach is to ignore the suspicion due to a lack of definitive proof. This fails to meet the regulatory obligation to report suspected market abuse, potentially allowing illicit activities to proceed and causing significant damage to market confidence and other participants. It also exposes the firm to regulatory penalties. Another incorrect approach is to directly question the client about the suspicious trading pattern. This could alert the client to the investigation, allowing them to destroy evidence, alter their behavior, or even take retaliatory action against the employee. It also breaches client confidentiality by revealing the suspicion prematurely and could lead to legal repercussions for the employee and the firm. A third incorrect approach is to report the suspicion to colleagues outside of the compliance department without proper authorization. This constitutes a breach of internal procedures and client confidentiality, potentially leading to the spread of unsubstantiated rumors, damage to the firm's reputation, and interference with a formal investigation. Professional reasoning. Professionals facing such situations should follow a structured decision-making process. First, identify the potential regulatory or ethical breach. Second, consult internal policies and procedures regarding suspicious activity reporting. Third, assess the level of risk and potential harm. Fourth, escalate the matter through the designated channels, e.g., compliance department with all relevant factual information. Fifth, maintain strict confidentiality throughout the process. This systematic approach ensures compliance, protects stakeholders, and upholds professional integrity. Question 6. The risk matrix shows a client's stated risk tolerance as moderate, Yet recent communications indicate a strong desire to invest in highly speculative assets with significant potential for capital loss. The client has expressed frustration with the perceived slow growth of their current moderate risk portfolio. What is the most appropriate course of action for the financial advisor? Option A. Inform the client that their request is inconsistent with their stated risk tolerance and refuse to consider any investments outside of their moderate risk profile. Option B. Suggest the client seek advice from a different financial institution that specializes in high-risk investments, as this institution may be better equipped to meet their current needs. Option C. Immediately execute the client's request to invest in speculative assets, as their current expressed desire overrides their previously stated risk tolerance. Option D. Engage in a detailed discussion with the client to understand the reasons behind their desire for speculative investments. Assess their comprehension of the associated risks, and document the conversation and any revised risk assessment before proceeding with any recommendations. Correct answer is D. Engage in a detailed discussion with the client to understand the reasons behind their desire for speculative investments, assess their comprehension of the associated risks, and document the conversation and any revised risk assessment before proceeding with any recommendations. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated risk tolerance and their actual investment behavior, which is further complicated by the need to adhere to Sberbank's internal policies and relevant regulatory requirements for client suitability and risk management. The challenge lies in interpreting ambiguous client signals and ensuring that investment recommendations are not only aligned with stated preferences, but also with the client's capacity to understand and bear the associated risks, as mandated by regulations governing financial advisory services. The correct approach represents best professional practice because it prioritizes a thorough, documented assessment of the client's understanding of risk, their financial situation, and their investment objectives, even when the client expresses a desire to deviate from their stated risk profile. This aligns with the principles of Know Your Client, KIC, and suitability, which are fundamental to responsible financial advice. By seeking clarification, documenting discussions, and potentially recommending a more conservative course of action or further education for the client, the advisor upholds their fiduciary duty and regulatory obligations to act in the client's best interest, preventing potential harm from unsuitable investments. This proactive and cautious stance is crucial for maintaining client trust and avoiding regulatory breaches. An incorrect approach that involves immediately proceeding with the client's aggressive investment request without further due diligence fails to adequately assess suitability. This could lead to a breach of regulatory requirements that mandate advisors to ensure investments are appropriate for the client's circumstances and risk tolerance. Ethically, it prioritizes immediate client satisfaction over the client's long-term well-being and financial security. Another incorrect approach, which is to dismiss the client's request outright without understanding the underlying reasons or attempting to educate them, might be perceived as paternalistic and could damage the client relationship. While it avoids the risk of an unsuitable investment, it fails to engage with the client's evolving financial thinking or potential misunderstanding of risk, thus not fully fulfilling the advisor's role in guiding the client. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's stated profile. When discrepancies arise, the next step is to investigate the cause of the discrepancy through open dialogue and questioning. This involves assessing the client's comprehension of the risks involved in their desired investment strategy. Documentation of all interactions, assessments, and decisions is paramount. If the client's understanding remains insufficient or their desired strategy demonstrably conflicts with their capacity to absorb losses, the professional should clearly articulate the risks, explain why the proposed investment may be unsuitable, and offer alternative, more appropriate solutions or recommend further client education. The ultimate decision must be justifiable based on regulatory requirements and ethical considerations, always prioritizing the client's best interests. Question 7. Benchmark analysis indicates that a client who initially completed a risk assessment questionnaire indicating a moderate risk tolerance and expressed a desire for long-term growth has become visibly distressed and anxious during recent market downturns, frequently contacting the advisor with concerns about potential losses. The advisor has observed a pattern of emotional reactions that suggest a lower actual risk tolerance than initially assessed. Considering the regulatory framework governing financial advisory services, what is the most appropriate course of action for the advisor? Option A. Rely solely on the initial risk assessment questionnaire and advise the client to ignore their current emotional responses, as these are considered temporary. Option B. Reassure the client that market volatility is normal and proceed with the existing investment strategy, as their initial risk assessment indicated a moderate tolerance. Option C. Initiate a detailed discussion with the client to reevaluate their risk tolerance based on their observed reactions, and propose adjustments to the investment portfolio to better align with their current comfort level and stated long-term goals. Option D. Immediately liquidate all assets deemed to be of higher risk within the client's portfolio to protect their capital from further potential losses. The correct answer is C. Initiate a detailed discussion with the client to reevaluate their risk tolerance based on their observed reactions and propose adjustments to the investment portfolio to better align with their current comfort level and stated long-term goals. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated investment goals and their actual risk tolerance, as revealed by their behavioral responses. The advisor must navigate this discrepancy while adhering to regulatory obligations and ethical principles, ensuring the client's best interests are paramount. The difficulty lies in interpreting subjective client feedback and translating it into objective investment decisions that align with both stated objectives and demonstrated capacity for risk. Correct approach analysis. The correct approach prioritizes a thorough reevaluation of the client's risk profile based on their observed reactions to market volatility. This aligns with the principles of Know Your Customer (KIC) and suitability, fundamental to financial advisory regulations. Specifically, it reflects the requirement to ensure that any investment recommendation is appropriate for the client's circumstances, knowledge, experience, and financial situation, including their risk tolerance. By revisiting the risk assessment and adjusting the portfolio accordingly, the advisor demonstrates a commitment to acting in the client's best interest, a core fiduciary duty. This proactive adjustment, based on concrete behavioral evidence, is a hallmark of responsible financial advice. Incorrect approaches analysis. One incorrect approach involves dismissing the client's behavioral responses as temporary emotional reactions and proceeding with the original investment plan. This fails to acknowledge the significance of risk tolerance as a dynamic factor that can be revealed through market events. It breaches the duty of care by not adequately assessing the client's current capacity to withstand potential losses, potentially leading to unsuitable investment recommendations. Another incorrect approach is to immediately liquidate all risky assets without further discussion or reassessment. While seemingly protective, this action bypasses the crucial step of understanding the client's underlying concerns and educating them on appropriate risk management strategies. It can be seen as an overreaction that may not align with the client's long-term financial goals and could lead to missed opportunities. This approach may also violate the principle of acting in the client's best interest if it is not a considered decision based on a revised understanding of their risk profile. A third incorrect approach is to solely rely on the initial risk assessment questionnaire, disregarding the client's subsequent reactions. This is a failure to conduct ongoing due diligence and to adapt advice to evolving client circumstances. Regulatory frameworks mandate that advisors remain aware of changes in a client's situation and risk tolerance, and a static reliance on outdated information is a clear breach of these requirements. Professional reasoning. Professionals should adopt a structured decision-making process that begins with acknowledging any discrepancies between stated goals and observed behavior. The next step involves a comprehensive review of the client's risk profile, incorporating both quantitative data, questionnaires, and qualitative observations, behavioral responses. This review should lead to a dialogue with the client to understand their concerns and to reestablish a mutually agreed-upon risk tolerance. Based on this revised understanding, the advisor should then propose an adjusted investment strategy that is demonstrably suitable and aligned with the client's best interests, ensuring clear communication and documentation throughout the process. Question 8. Regulatory review indicates that a long-standing, high-net-worth client of Sberbank has recently conducted a series of unusually large cash deposits into their account, followed by immediate wire transfers to an offshore entity with a known history of opaque financial dealings. The client has provided no clear business justification for these transactions, and their usual transaction patterns have been significantly altered. The employee handling the account is aware of the client's importance to the bank's revenue. What is the most appropriate course of action? Option A. Immediately file a suspicious activity report (SAR) with the relevant authorities, detailing all observed transactions and the lack of client explanation. Option B. Ignore the transactions, given the client's significant contribution to the bank's profitability, and continue to process them as usual. Option C. Conduct further discrete inquiries to gather more information about the client's business activities and the purpose of the offshore transfers, consulting with the bank's compliance department before any external reporting. Option D. Discuss the observed transactions and the bank's concerns directly with the client to seek clarification and reassurance. The correct answer is A. Immediately file a suspicious activity report (SAR) with the relevant authorities, detailing all observed transactions and the lack of client explanation. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The employee must navigate the delicate balance of protecting client information while adhering to anti-money laundering (AML) regulations. Careful judgment is required to identify potential red flags without prematurely breaching client trust or making unsubstantiated accusations. The correct approach represents best professional practice because it prioritizes a thorough, objective assessment of the situation before escalating. This aligns with regulatory frameworks that mandate reporting of suspected money laundering, not mere suspicion without investigation. By gathering additional information and consulting with the compliance department, the employee demonstrates due diligence, a core principle in AML compliance. This process ensures that any report filed is well-founded, minimizing the risk of false accusations and protecting the firm from potential reputational damage or regulatory penalties for unfounded reporting. It also upholds the ethical duty to treat clients fairly and with respect, pending concrete evidence of wrongdoing. An incorrect approach that immediately reports the client without further investigation fails to meet the standard of reasonable suspicion. It risks violating client confidentiality unnecessarily and could lead to regulatory scrutiny for filing a baseless suspicious activity report (SAR). This demonstrates a lack of due diligence and an overzealous, rather than judicious, application of AML procedures. Another incorrect approach, that of ignoring the transaction due to the client's importance, represents a severe ethical and regulatory failure. It directly contravenes AML obligations to monitor and report suspicious activity, regardless of client status. This could expose the firm to significant legal and financial penalties, including fines and reputational damage, and constitutes a dereliction of professional duty. It also creates a moral hazard, suggesting that certain clients are above regulatory scrutiny. A third incorrect approach, that of discussing the suspicion with the client directly, is also professionally unacceptable. This action would likely tip off the client, allowing them to further conceal or move illicit funds, thereby obstructing a potential investigation and undermining the purpose of AML regulations. It also breaches client confidentiality in an unauthorized manner and could be construed as aiding and abetting illicit activities. The professional reasoning process for similar situations involves a structured approach. 1. Identify potential red flags based on established AML policies and procedures. 2. Gather objective information to corroborate or refute the initial suspicion. 3. Consult with the designated compliance officer or department for guidance and expert assessment. 4. Document all steps taken, observations, and decisions made. 5. Only escalate to formal reporting, e.g., filing a SAR if a reasonable suspicion of money laundering persists after thorough investigation and consultation. 6. Maintain strict confidentiality throughout the process, only sharing information on a need-to-know basis with authorized personnel. Question 9. The performance metrics show a sudden surge in trading activity for a specific equity, accompanied by a corresponding increase in client-initiated calls and messages inquiring about the same stock. The firm's internal surveillance system has flagged this pattern as potentially unusual. What is the most appropriate immediate course of action for the firm's compliance department? Option A. Initiate a comprehensive review of trading data, client communications, and any public announcements related to the security to identify any potential market abuse or insider trading activity, while also assessing the nature of client inquiries. Option B. Alert the relevant regulatory authorities about the increased trading volume, assuming it is indicative of market manipulation, and await their instructions. Option C. Advise all client-facing staff to refrain from discussing the security with clients until further notice, without conducting any initial investigation. Option D. Immediately issue a firm-wide recommendation to clients to increase their positions in the security, citing the observed market momentum. Correct answer is A. Initiate a comprehensive review of trading data, client communications, and any public announcements related to the security to identify any potential market abuse or insider trading activity, while also assessing the nature of client inquiries. Explanation: the performance metrics show a significant increase in trading volume for a particular security, coupled with a noticeable uptick in client inquiries about that same security. This scenario presents a professional challenge because it requires distinguishing between legitimate market interest and potential market manipulation or insider trading. The firm must act diligently to protect its clients and the integrity of the market, adhering strictly to Sberbank's internal policies and relevant Russian Federation regulations governing financial markets. The correct approach involves a multifaceted investigation. This includes reviewing the source of the increased trading volume, e.g., news events, analyst reports, significant corporate announcements, cross-referencing client inquiries with known information and client profiles, and scrutinizing trading patterns for any anomalies that might suggest coordinated activity or the use of non-public information. This aligns with the principles of market integrity and client protection mandated by Russian financial market laws, which require financial institutions to have robust systems for detecting and preventing market abuse. It also reflects Sberbank's ethical obligation to act in the best interests of its clients and to maintain a fair and orderly market. An incorrect approach would be to dismiss the increased activity as mere market fluctuation without further investigation. This fails to meet the regulatory obligation to monitor for and report suspicious activities, potentially exposing the firm and its clients to risks associated with market manipulation or insider trading. Another incorrect approach would be to proactively recommend the security to all clients based solely on the increased volume, without considering the underlying reasons or potential risks, which could be construed as providing unsuitable investment advice and potentially facilitating market manipulation. A third incorrect approach would be to immediately halt all trading in the security without sufficient evidence of wrongdoing, which could unfairly prejudice clients and disrupt legitimate market activity. Professionals should adopt a structured decision-making process. First, identify and assess potential risks based on observed data. Second, gather all relevant information through internal systems and, if necessary, external sources. Third, analyze the information against regulatory requirements and internal policies. Fourth, consult with compliance and legal departments when uncertainty or potential breaches are identified. And finally, take appropriate action based on a thorough and documented assessment. Question 10. The control framework reveals that a client who initially declared a moderate risk tolerance has recently expressed significant anxiety and a desire to liquidate a substantial portion of their diversified equity portfolio following a short-term market downturn. The financial advisor is tasked with determining the most appropriate course of action. Option A. Immediately execute the client's request to liquidate the portfolio to alleviate their immediate distress, assuming their current emotional state accurately reflects their true risk tolerance. Option B. Initiate a detailed discussion with the client to understand the root cause of their anxiety, re-explain the long-term investment strategy and the rationale behind the current portfolio allocation, and assess if their risk tolerance has genuinely shifted. Before proposing any adjustments, Option C. Advise the client to temporarily suspend all investment activities and wait for the market to stabilize before making any decisions, without further discussion of their current portfolio or risk tolerance. Option D. Proceed with the investment recommendations as originally planned, reassuring the client that market fluctuations are normal and that no action is required based on their initial stated risk tolerance. The correct answer is B. Initiate a detailed discussion with the client to understand the root cause of their anxiety, re-explain the long-term investment strategy and the rationale behind the current portfolio allocation, and assess if their risk tolerance has genuinely shifted before proposing any adjustments. Explanation: This scenario presents a professional challenge due to the inherent conflict between a client's stated risk tolerance and their actual investment behavior, which is often influenced by market volatility and emotional responses. The need for careful judgment arises from the obligation to act in the client's best interest, which requires a nuanced understanding beyond stated preferences. This involves assessing whether the client truly comprehends the implications of their risk tolerance, or if their actions are driven by short-term market fluctuations. The correct approach represents best professional practice because it prioritizes a comprehensive and ongoing assessment of the client's suitability. This aligns with regulatory requirements, such as those found in the Sberbank hiring assessment tests implied jurisdiction, likely Russian Federation, given Sberbank's origin, which mandate that financial institutions understand their clients' financial situation, investment objectives, and risk tolerance before recommending any products or services. It also reflects ethical obligations to provide suitable advice and to protect clients from making decisions that could be detrimental to their financial well-being. This approach involves proactive communication, education, and a willingness to reevaluate suitability when circumstances change or when observed behavior deviates from stated preferences. An incorrect approach that solely relies on the client's initial stated risk tolerance without further verification or ongoing monitoring fails to meet regulatory standards for client suitability. This could lead to the provision of inappropriate investment products, exposing the client to undue risk and potentially resulting in significant financial losses. Ethically, this constitutes a failure to act in the client's best interest and a breach of the duty of care. Another incorrect approach that immediately overrides the client's stated risk tolerance based on a single instance of perceived overreaction, without a thorough discussion or understanding of the underlying reasons for the client's actions, is also professionally unacceptable. While the intention might be to protect the client, it undermines client autonomy and can damage the professional relationship. It may also be seen as paternalistic and not in line with the principle of informed consent, which is a cornerstone of financial advisory practice. The professional decision-making process for similar situations should involve a structured approach. 1. Initial assessment. Conduct a thorough initial assessment of the client's financial situation, investment objectives, and risk tolerance, using a combination of questionnaires and in-depth discussions. 2. Behavioral observation. Continuously monitor client behavior and investment decisions, looking for discrepancies between stated preferences and actual actions. 3. Proactive communication and education. Engage in regular, transparent communication with the client, explaining market dynamics, the rationale behind investment recommendations, and the potential impact of their risk tolerance. Educate them on the long-term implications of their investment strategy. 4. Reevaluation of suitability. If significant deviations occur or if market conditions change drastically, proactively reevaluate the client's suitability and discuss any necessary adjustments to their investment strategy. 5. Documentation. Maintain detailed records of all client interactions, assessments, recommendations, and decisions. Question 11. Implementation of a new client onboarding process at Sberbank has led to a junior analyst reviewing documentation for a prospective corporate client. During this review, the analyst identifies several transactions with entities in jurisdictions known for high levels of corruption and a pattern of complex layered transfers that lack clear economic justification. The analyst is unsure whether these indicators constitute a reportable suspicious activity under Russian Federation regulations. Option A. Directly contact the prospective client to inquire about the nature and purpose of the identified transactions to clarify the situation. Option B. Proceed with onboarding the client as planned, assuming the transactions are legitimate until proven otherwise, and document the observations for future reference. Option C. Escalate the findings immediately to the bank's compliance department and the designated anti-money laundering officer for further investigation and potential reporting to Rosfin monitoring. Option D. Discuss the suspicious findings with a senior colleague in a different department to seek their opinion on how to proceed. The correct answer is C. Escalate the findings immediately to the bank's compliance department and the designated anti-money laundering officer for further investigation and potential reporting to Rosfin monitoring. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. A junior analyst, tasked with preparing a client profile, discovers information that could indicate potential money laundering. The challenge lies in balancing the duty of loyalty and discretion owed to the client with the paramount responsibility to uphold financial integrity and comply with anti-money laundering (AML) regulations. Misjudging this balance can lead to severe regulatory penalties, reputational damage, and ethical breaches. The correct approach represents best professional practice because it prioritizes regulatory compliance and the integrity of the financial system. By escalating the concern through the designated internal channels, the analyst adheres to the established procedures for handling suspicious activity reports (SAR). This ensures that the information is reviewed by trained compliance personnel who can assess the situation objectively and make an informed decision about reporting to the relevant authorities, such as Rosfin monitoring in the Russian Federation. This process upholds the spirit and letter of AML laws, which mandate reporting of suspicious transactions and activities, thereby contributing to the prevention of financial crime. An incorrect approach of ignoring the information or directly confronting the client would be professionally unacceptable. Ignoring the information constitutes a failure to comply with AML obligations, potentially making the firm complicit in illicit activities and exposing it to significant fines and sanctions under Russian AML legislation. Federal Law No. 115 FZ on countering the legalization, laundering of proceeds from crime and the financing of terrorism. Directly confronting the client without proper authorization or procedure risks tipping off the individual, which is a criminal offense under Russian law and can obstruct investigations. Another incorrect approach, such as discussing the suspicion with colleagues outside of the official reporting line, violates client confidentiality and could lead to the unauthorized disclosure of sensitive information, also contravening regulatory requirements and ethical standards. Professionals should employ a decision-making framework that begins with identifying potential red flags. Upon detection, the next step is to consult internal policies and procedures for handling such situations. If a regulatory reporting obligation is suspected, the professional must follow the prescribed escalation path, typically involving reporting to the compliance department or a designated AML officer. This ensures that the matter is handled by those with the expertise and authority to act, while maintaining appropriate documentation and confidentiality. The guiding principle is to act in accordance with legal and regulatory mandates, prioritizing the integrity of the financial system and the firm's compliance obligations. Question 12. Quality control measures reveal that a client, who is a significant investor in a particular stock, has been making a series of unusually large buy orders just before the market close for several consecutive days, followed by equally large sell orders shortly after the market opens the following day. The client claims these are simply rebalancing activities to manage their portfolio's exposure. What is the most appropriate course of action for the employee who identified this pattern? Option A. Advise the client directly that their trading patterns are raising concerns and suggest they adjust their strategy to avoid suspicion. Option B. Continue to monitor the client's trading activity without taking further action, assuming the client's explanation is valid. Option C. Conduct a preliminary, discrete review of the client's trading history and market context to gather more information before consulting with the compliance department. Option D. Immediately report the client's trading activity to the compliance department as potential market manipulation, citing the unusual order patterns. The correct answer is D. Immediately report the client's trading activity to the compliance department as potential market manipulation, citing the unusual order patterns. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential market abuse. The employee must navigate the delicate balance of protecting client information while upholding the integrity of the financial markets, as mandated by Sberbank's internal policies and relevant Russian regulations governing securities markets. The difficulty lies in discerning whether the client's actions constitute a genuine misunderstanding or a deliberate attempt to manipulate the market, requiring a nuanced understanding of market abuse indicators. The correct approach represents best professional practice because it prioritizes a thorough, objective investigation before escalating. This aligns with the principles of due diligence and fair treatment of clients. By gathering all relevant facts and consulting with the compliance department, the employee ensures that any action taken is well-founded and proportionate, minimizing the risk of unfounded accusations or breaches of confidentiality. This proactive and structured approach is crucial for maintaining client trust and adhering to regulatory requirements, such as those outlined in Federal Law No. 39 FZ on the securities market and the Central Bank of Russia's directives on market abuse. An incorrect approach that involves immediate reporting without investigation would be a significant regulatory and ethical failure. It breaches the principle of client confidentiality by prematurely disclosing sensitive information without sufficient grounds. This could lead to reputational damage for both the client and Sberbank, and potentially expose Sberbank to legal repercussions for wrongful accusations. Another incorrect approach, such as ignoring the potential red flags, constitutes a failure to comply with Sberbank's internal control procedures and regulatory obligations to detect and report market abuse. This inaction could allow market manipulation to occur, undermining market integrity and potentially leading to severe penalties for Sberbank and its employees. The professional decision-making process should involve a systematic evaluation of the situation. First, identify the potential red flags and the specific regulations or internal policies they might violate. Second, gather all available information objectively without making assumptions. Third, consult with the appropriate internal departments, such as compliance or legal, to seek guidance and ensure adherence to procedures. Fourth, document all steps taken and decisions made. Finally, act based on a comprehensive understanding of the facts and regulatory requirements, always prioritizing ethical conduct and the integrity of the financial markets. Question 13. The control framework reveals that a senior investment analyst at Sberbank has recently acquired a substantial personal stake in a technology firm. This firm is now being considered by Sberbank for a significant advisory role in an upcoming merger and acquisition transaction. The analyst is a key member of the team evaluating this potential advisory engagement. What is the most appropriate course of action for the analyst to ensure compliance with ethical standards and regulatory requirements? Option A. Proceed with the evaluation, confident that their professional judgment will not be compromised by their personal investment, and focus on providing objective advice to Sberbank. Option B. Sell the personal investment discreetly before the advisory role is finalized, without informing anyone of the personal holding or the sale. Option C. Immediately disclose the personal investment to the compliance department and recuse themselves from all discussions, evaluations, and decision-making processes related to the technology firm's potential advisory role. Option D. Discuss the situation with a trusted colleague outside the immediate deal team to get a second opinion on the firm's suitability for the advisory role, without formally disclosing the personal investment. Correct answer is C. Immediately disclose the personal investment to the compliance department and recuse themselves from all discussions, evaluations, and decision-making processes related to the technology firm's potential advisory role. Explanation. The control framework reveals a potential conflict of interest scenario within Sberbank's investment advisory division. A senior analyst, responsible for recommending securities to clients, has a significant personal investment in a company that is about to be the subject of a major Sberbank brokered deal. This situation is professionally challenging because it blurs the lines between objective client advice and personal financial gain, potentially compromising the integrity of Sberbank's services and client trust. Careful judgment is required to navigate the ethical and regulatory implications. The correct approach, which involves immediate disclosure of the personal investment to the compliance department and recusal from any decision-making or advisory role concerning the company in question, represents best professional practice. This aligns with Sberbank's internal policies and the broader regulatory expectations for financial institutions, which mandate transparency and the avoidance of conflicts of interest. Specifically, it adheres to principles of client protection and market integrity, ensuring that client recommendations are based solely on the client's best interests and not influenced by the advisor's personal holdings. This proactive disclosure and recusal mitigates the risk of insider trading allegations and upholds the fiduciary duty owed to clients. An incorrect approach that involves proceeding with recommendations without disclosure, believing personal holdings will not influence judgment, represents a significant ethical and regulatory failure. This violates the principle of acting in the client's best interest and creates an undisclosed conflict of interest, which is a direct contravention of Sberbank's Code of Conduct, and potentially the central bank of Russia's regulations concerning market conduct and investor protection. Another incorrect approach, which is to sell the personal holdings immediately before the deal is announced without disclosing the intent to trade or the underlying reason, is also problematic. While it might seem like a way to avoid conflict, it could still be construed as an attempt to profit from non-public information, if not handled with extreme care and proper disclosure of the timing and rationale for the sale to compliance. This could still lead to scrutiny and potential accusations of market manipulation or insider trading. A third incorrect approach, which is to seek advice from a junior colleague to validate the recommendations without disclosing the personal interest, is a failure of personal responsibility and transparency. It attempts to shift accountability without addressing the root conflict of interest and still exposes Sberbank and its clients to risk. The professional decision-making process for similar situations should involve a clear multi-step approach. 1. Identify potential conflicts of interest immediately. 2. Consult Sberbank's internal policies and relevant regulations. 3. Disclose the conflict to the appropriate internal authority, e.g., Compliance Department. 4. Seek guidance on recusal or other mitigation strategies. 5. Document all actions taken and decisions made. This systematic process ensures that ethical standards are maintained and regulatory obligations are met, safeguarding both the individual's professional standing and the institution's reputation. Question 14. The assessment process reveals that a junior analyst, during preliminary research for a potential investment in a technology firm, has inadvertently received information from an acquaintance working at the target company. This information, if true, could significantly alter the perceived value of the company, but it has not yet been publicly disclosed. The analyst is unsure how to proceed with this information in the context of Sberbank's internal assessment protocols and Russian Federation financial market regulations. Which of the following actions best reflects professional and regulatory best practice? Option A. Conduct further informal inquiries with other contacts to corroborate the information before deciding whether to report it. Option B. Immediately report the information to Sberbank's compliance department and await their guidance on how to proceed with the assessment. Option C. Disregard the information entirely as it was obtained informally and may not be reliable. Option D. Incorporate the information into the valuation analysis discreetly, assuming it is accurate and will eventually become public. The correct answer is B. Immediately report the information to Sberbank's compliance department and await their guidance on how to proceed with the assessment. Explanation. The assessment process reveals a scenario where a junior analyst, tasked with evaluating a potential investment in a new technology startup, discovers information that could significantly impact the valuation. This information, while not yet public, was obtained through informal networking with an employee of the target company. The challenge lies in balancing the duty to conduct thorough due diligence with the ethical and regulatory obligations concerning insider information. The analyst must determine the appropriate course of action without jeopardizing the integrity of the assessment or violating Sberbank's internal policies and relevant Russian Federation regulations governing financial markets and insider trading. The correct approach involves immediately reporting the discovered information through the designated internal channels, adhering to Sberbank's compliance procedures for handling potentially material non-public information. This aligns with the principles of market integrity and fair dealing, as mandated by Russian Federation laws such as Federal Law No. 224 FZ, on counteracting the illegal use of insider information and market manipulation, and on amendments to certain legislative acts of the Russian Federation. This law strictly prohibits the use of insider information for trading or for making recommendations. By reporting, the analyst ensures that the information is handled by the appropriate compliance and legal departments, who can then assess its materiality and determine if it constitutes insider information. This process safeguards against any potential misuse and upholds Sberbank's commitment to regulatory compliance and ethical conduct. An incorrect approach would be to proceed with the investment recommendation based on this information without disclosure. This directly violates the spirit and letter of Russian insider trading laws, which aim to prevent unfair advantages and maintain market confidence. Such an action could lead to severe penalties for both the individual and Sberbank, including fines and reputational damage. Another incorrect approach would be to disregard the information entirely, assuming it is insignificant. This fails to meet the professional standard of due diligence and could expose Sberbank to undue risk if the information is indeed material. It also neglects the ethical responsibility to act with prudence and thoroughness. A third incorrect approach might be to subtly incorporate the information into the analysis without explicit disclosure, hoping it goes unnoticed. This is a form of deception and a clear breach of ethical conduct and regulatory requirements, as it still involves the use of potentially non-public information without proper authorization and assessment. Professionals should adopt a decision-making framework that prioritizes transparency, adherence to internal policies, and strict compliance with all applicable regulations. When faced with potentially sensitive information, the immediate step should always be to consult internal compliance and legal departments. This ensures that any action taken is informed, lawful, and ethically sound, protecting both the individual and the institution. Question 15. Investigation of a financial advisor's response to a client expressing significant anxiety and a desire to reduce risk exposure following a period of market downturn, despite the client's previously stated long-term growth objectives and moderate risk tolerance. The advisor notes the client's increased emotional distress and a tendency to check portfolio performance more frequently, indicating a potential shift in their actual risk-bearing capacity. Option A. Dismiss the client's concerns as an overreaction to short-term market fluctuations, emphasizing that their original investment plan was based on a more rational assessment of risk and should not be altered due to temporary emotional responses. Option B. Immediately liquidate all equity holdings and reallocate the entire portfolio into ultra-low-risk government bonds and cash equivalents, without further consultation or reevaluation of the client's long-term financial goals. Option C. Reassure the client that market downturns are temporary and that their long-term growth strategy remains sound, advising them to avoid frequent portfolio checks and to maintain their current investment allocation. Option D. Conduct a thorough review of the client's financial situation, risk tolerance, and investment objectives. Engage in a detailed discussion about their concerns and the implications of market volatility, and propose a revised portfolio allocation that balances their stated goals with their demonstrated risk aversion. The correct answer is D. Conduct a thorough review of the client's financial situation, risk tolerance, and investment objectives. Engage in a detailed discussion about their concerns and the implications of market volatility, and propose a revised portfolio allocation that balances their stated goals with their demonstrated risk aversion. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated investment objectives and their actual risk tolerance, as revealed by their behavioral response to market volatility. A financial advisor must navigate this discrepancy to ensure the client's portfolio remains aligned with their true capacity and willingness to bear risk, thereby upholding their fiduciary duty and adhering to regulatory requirements for suitability. The difficulty lies in interpreting subjective client feedback and translating it into objective portfolio adjustments without alienating the client or making assumptions that could lead to misaligned investments. Correct approach analysis. The correct approach involves a comprehensive review of the client's financial situation, risk tolerance, and investment objectives, followed by a proactive discussion and adjustment of the portfolio. This aligns with the principles of Know Your Customer (KIC) and suitability requirements mandated by financial regulations. Specifically, it reflects the duty to ensure that any investment recommendation or portfolio management strategy is appropriate for the client's circumstances, including their ability to withstand losses and their stated goals. This approach prioritizes the client's best interests by acknowledging and acting upon new information that impacts their risk profile, demonstrating professional diligence and ethical responsibility. Incorrect approach is analysis. One incorrect approach involves dismissing the client's expressed concerns as temporary emotional reactions and maintaining the current portfolio without further investigation. This fails to acknowledge the client's demonstrated risk aversion and could lead to a portfolio that is no longer suitable, potentially causing significant financial harm and violating regulatory obligations to act in the client's best interest. It also demonstrates a lack of professional judgment in assessing client behavior. Another incorrect approach is to immediately liquidate all risky assets and move to extremely conservative investments based solely on the client's immediate distress. While addressing risk is important, such an abrupt and drastic shift without a thorough reevaluation of the client's long-term objectives and a structured discussion can be detrimental. It may not align with the client's original long-term goals and could lead to missed opportunities for growth, potentially violating the suitability standard by not offering a balanced solution. A third incorrect approach is to simply reassure the client that the market will recover and to do nothing, without any attempt to understand the root cause of their anxiety, or to review the portfolio's current allocation in light of their expressed discomfort. This passive stance ignores the client's expressed needs and the potential for their risk tolerance to have fundamentally shifted, thereby failing to meet the professional standard of care and potentially breaching regulatory requirements for ongoing portfolio suitability. Professional reasoning. Professionals should adopt a structured decision-making process that begins with active listening and empathetic engagement with the client's concerns. This should be followed by a systematic reevaluation of the client's profile, considering both objective financial data and subjective behavioral indicators. Any proposed adjustments must be clearly communicated, with a rationale that links back to the client's revised risk tolerance and overarching financial goals. This iterative process ensures that advice and actions are consistently aligned with the client's best interests and regulatory mandates. Question 16. What factors determine the appropriate level of detail and the specific methods used to assess a client's risk tolerance when their stated investment objectives appear to conflict with their expressed concerns about market volatility? Option A. The client's stated investment objectives, their capacity to absorb losses, their emotional response to market fluctuations, and the complexity of the proposed investment products. Option B. Prevailing market sentiment and the historical performance of similar investment strategies, irrespective of the client's individual circumstances. Option C. The advisor's personal opinion on the client's financial acumen and the perceived ease of selling a particular investment product. Option D. The client's age and the duration of their investment horizon, without considering their actual comfort level with risk. The correct answer is A. The client's stated investment objectives, their capacity to absorb losses, their emotional response to market fluctuations, and the complexity of the proposed investment products. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated investment objectives and their actual risk tolerance, as revealed through their behavior and stated concerns. A financial advisor must navigate this discrepancy to ensure compliance with regulatory requirements for suitability and client best interests, while also maintaining a strong client relationship. The core difficulty lies in interpreting subjective client feedback and aligning it with objective financial product characteristics. The correct approach represents best professional practice because it prioritizes a thorough, documented assessment of the client's risk profile, considering both stated preferences and observed behavior. This aligns with the principles of Know Your Customer, KIC, and suitability, as mandated by financial regulations. By actively seeking to understand the client's underlying concerns and adjusting recommendations accordingly, the advisor demonstrates a commitment to acting in the client's best interest, a fundamental ethical and regulatory obligation. This proactive and client-centric methodology ensures that investment decisions are not only aligned with stated goals, but also with the client's capacity and willingness to bear risk, thereby mitigating potential future dissatisfaction and regulatory breaches. An incorrect approach that focuses solely on the client's initial stated objectives, without further investigation into their risk tolerance, fails to meet the regulatory standard of suitability. This could lead to the recommendation of investments that are too risky for the client, potentially resulting in significant losses and a breach of fiduciary duty. Another incorrect approach, which dismisses the client's expressed concerns as mere emotional reactions, ignores crucial qualitative data about their risk perception. This can lead to a misdiagnosis of the client's true needs and a failure to adapt the investment strategy, potentially causing distress and a loss of trust. Finally, an approach that prioritizes the sale of a specific product over a comprehensive client assessment, even if it superficially aligns with stated goals, is ethically unsound and likely to violate regulations designed to protect investors. The professional decision-making process in such situations should involve a structured approach. First, clearly define the client's stated objectives and constraints. Second, conduct a comprehensive risk assessment, utilizing both questionnaires and open-ended discussions to gauge their risk tolerance and capacity. Third, critically evaluate any discrepancies between stated preferences and observed behavior or expressed concerns. Fourth, develop a range of suitable investment strategies that address the client's profile, explaining the risks and potential rewards of each. Fifth, document all discussions, assessments, and decisions thoroughly. Finally, regularly review and adapt the investment strategy based on ongoing client feedback and market conditions. Question 17. When evaluating investment product recommendations for a client, what is the most appropriate course of action for a Sberbank financial advisor who identifies that product with a significantly higher commission for the bank also appears to be a suitable option for the client's stated financial goals and risk tolerance? Option A. Focus on recommending products with the lowest possible commission to demonstrate a commitment to minimizing client costs, even if slightly less optimal for achieving their specific goals. Option B. Prioritize recommending the product with the highest commission for Sberbank, as this aligns with the firm's business objectives and provide a general overview of its features. Option C. Recommend the product that best aligns with the client's financial goals and risk tolerance, regardless of the commission structure, and transparently disclose all relevant product features and associated costs. Option D. Recommend a product with a moderate commission that is clearly suitable, even if a higher commission product might also be suitable, to avoid any perception of conflict of interest. Correct answer is C. Recommend the product that best aligns with the client's financial goals and risk tolerance, regardless of the commission structure, and transparently disclose all relevant product features and associated costs. Explanation. This scenario presents a professional challenge due to the inherent conflict between client interests and the firm's potential for increased revenue. The advisor must navigate this by prioritizing the client's best interests, as mandated by regulatory frameworks governing financial advice. The core of the challenge lies in identifying and mitigating conflicts of interest, ensuring transparency, and acting with integrity. The correct approach represents best professional practice because it aligns with the fundamental principles of fiduciary duty and client centricity, embedded within the Sberbank's internal guidelines and relevant Russian Federation financial regulations. Specifically, it emphasizes understanding the client's financial situation, risk tolerance, and objectives before recommending any product. This ensures that the recommendation is suitable and serves the client's needs, rather than the firm's profit motive. Adherence to these principles prevents mis-selling and builds long-term client trust, which is crucial for sustainable business. An incorrect approach that prioritizes higher commission products without a thorough suitability assessment fails to uphold the client's best interests. This constitutes a breach of ethical conduct and potentially violates regulations requiring advisors to act in good faith and with due diligence. Recommending a product solely based on its commission structure, without considering its appropriateness for the client's specific circumstances, can lead to financial harm for the client and reputational damage for the advisor and Sberbank. Another incorrect approach might involve disclosing the commission structure, but still pushing the higher commission product, which, while partially transparent, still prioritizes firm revenue over client suitability, thus failing the spirit of client protection regulations. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the client's profile and objectives. Second, identify all available product options that meet these criteria. Third, evaluate each option based on suitability, fees, risks, and potential returns, considering the client's perspective. Fourth, clearly and transparently communicate the features, risks, and benefits of the recommended product, including any associated costs or commissions, ensuring the client fully understands. Finally, document the entire process, including the rationale for the recommendation, to demonstrate compliance and adherence to best practices. Question 18. Governance review demonstrates that a long-standing, high-net-worth client has proposed a complex international tax structuring arrangement. While the client asserts the arrangement is for legitimate tax planning purposes, the structure involves multiple offshore entities and intricate fund flows that could potentially obscure the ultimate beneficial ownership and source of funds. The institution's compliance department has flagged this as a potentially high-risk activity requiring enhanced scrutiny. What is the most appropriate course of action for the financial institution to take in this situation? Option A. Conduct enhanced due diligence, including detailed verification of the economic substance and legitimacy of the proposed tax structure, seeking further clarification from the client and their advisors, and consulting with the institution's internal compliance and legal departments before proceeding. Option B. Proceed with the client's proposed tax structuring arrangement as requested, relying on the client's assurances and the fact that they are a valued long-term customer, assuming their external tax advisors have ensured compliance. Option C. Immediately reject the client's proposed tax structuring arrangement due to the inherent risks associated with offshore entities and complex fund flows, to avoid any potential regulatory scrutiny. Option D. Delegate the entire responsibility for assessing the legitimacy and compliance of the tax structure to the client's external tax advisors, accepting their opinion without independent internal review. Correct answer is A. Conduct enhanced due diligence, including detailed verification of the economic substance and legitimacy of the proposed tax structure, seeking further clarification from the client and their advisors, and consulting with the institution's internal compliance and legal departments before proceeding. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax planning and the financial institution's obligation to adhere to regulatory requirements and ethical standards. The challenge lies in balancing client service with the imperative to prevent financial crime and ensure compliance, particularly in the context of evolving anti-money laundering (AML) and tax evasion regulations. The pressure to retain a high-value client can create a temptation to overlook potential red flags, making robust internal controls and professional judgment paramount. Correct approach analysis. The correct approach involves a thorough, multifaceted due diligence process that goes beyond standard Know Your Customer (KIC) procedures. This includes scrutinizing the proposed tax structure for any indicators of aggressive or potentially illegal tax avoidance, seeking clarification from the client on the legitimacy and economic substance of the transactions, and consulting with the institution's compliance and legal departments. This approach aligns with the principles of robust AML and counter-terrorist financing (CTF) frameworks, which mandate a risk-based approach to customer due diligence and transaction monitoring. Specifically, it reflects the spirit of regulations requiring financial institutions to understand the source of funds and wealth, and to report suspicious activities. Ethically, it upholds the duty of care to the client by ensuring their activities are compliant and sustainable, while also protecting the institution from reputational damage and legal penalties. Incorrect approaches analysis. One incorrect approach involves proceeding with the client's proposed structure without further investigation, relying solely on the client's assurances and the fact that they are a long-standing customer. This fails to meet the regulatory requirement for enhanced due diligence when dealing with potentially high-risk activities, such as complex international tax planning. It creates a significant risk of facilitating tax evasion or money laundering, leading to severe regulatory penalties, fines, and reputational damage for the institution. Ethically, it represents a dereliction of duty to prevent financial crime. Another incorrect approach is to immediately reject the client's request without understanding the underlying rationale or exploring compliant alternatives. While caution is necessary, an outright refusal without due diligence can be detrimental to client relationships and may not be justified if the proposed structure, upon proper review, is found to be legitimate. This approach lacks the nuanced risk assessment required by regulations and can be perceived as poor customer service, potentially driving clients to less scrupulous institutions. A third incorrect approach is to delegate the entire responsibility for assessing the tax structure's legitimacy to the client's external tax advisors without independent verification or internal review. While external advice is valuable, the financial institution retains ultimate responsibility for its own compliance and risk management. Relying solely on third-party assurances without internal scrutiny can lead to overlooking critical compliance gaps or misinterpretations of regulatory intent. Professional reasoning. Professionals should adopt a structured decision-making process that prioritizes regulatory compliance and ethical conduct. This involves 1. Risk identification, recognizing the potential risks associated with the client's request, particularly concerning tax evasion and money laundering. 2. Information gathering, conducting thorough due diligence, including understanding the client's business, the proposed transactions, and the source of funds. 3. Consultation, engaging with internal compliance, legal, and tax specialists, as well as potentially seeking external expert advice if necessary. 4. Risk assessment, evaluating the identified risks against the institution's risk appetite and regulatory obligations. 5. Decision-making, determining the appropriate course of action, which may include proceeding with enhanced controls, requesting further information, or declining the business if risks cannot be mitigated. 6. Documentation, maintaining comprehensive records of the due diligence process, risk assessment, and decision-making rationale. Question 19. Process analysis reveals that a long-standing client, known for their legitimate but complex international trading activities, has recently begun making a series of unusually large cash deposits into their account, followed by immediate transfers to offshore entities with opaque beneficial ownership structures. The client has provided vague explanations for the source of these funds, citing family inheritance and private investments. While the client's overall business is legitimate, the pattern of transactions and the lack of clear documentation for the cash deposits raise concerns about potential money laundering activities. What is the most appropriate course of action for the employee to take in this situation? Option A. Immediately report the suspicious activity to the designated compliance officer and provide all relevant documentation and observations. Option B. Conduct an independent investigation into the offshore entities receiving the funds before reporting anything to compliance. Option C. Continue to process the transactions as usual, assuming the client's explanations are sufficient, to avoid disrupting the client relationship and potential business. Option D. Directly question the client about the source of the cash deposits and demand more detailed documentation before taking any further action. Correct answer is A. Immediately report the suspicious activity to the designated compliance officer and provide all relevant documentation and observations. Explanation. This scenario presents a professional challenge rooted in the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The challenge lies in balancing the duty of loyalty to the client with the broader responsibility to maintain market integrity and prevent financial crime, as mandated by Sberbank's internal policies and relevant Russian Federation regulations concerning anti-money laundering (AML) and counter-terrorist financing (CTF). A professional must exercise sound judgment to identify when a client's actions cross the line from legitimate, albeit unusual, behavior to potentially illicit activity requiring disclosure. The correct approach represents best professional practice because it prioritizes adherence to regulatory requirements and internal compliance procedures. By escalating the situation to the designated compliance officer, the employee demonstrates an understanding of their reporting obligations under AML/CTF laws and Sberbank's internal control framework. This action ensures that the matter is investigated by trained professionals who can assess the situation against established criteria for suspicious activity reporting, thereby fulfilling the legal and ethical duty to report without prematurely breaching client confidentiality. This aligns with the principles of due diligence and the Know Your Customer (KIC) requirements, which are fundamental to preventing financial crime. An incorrect approach that involves directly confronting the client about the suspected illicit activity without prior consultation with compliance is professionally unacceptable. This could alert the client, potentially leading to the destruction of evidence, further concealment of illicit funds, or even retaliation against the employee. It also bypasses the established internal reporting channels, which is a direct violation of Sberbank's AML/CTF policies and potentially Russian Federation regulations that stipulate specific procedures for handling suspicious transactions. Furthermore, it places the employee in a position of making a judgment call on the legality of the client's actions, a responsibility that rests with the compliance department and, if necessary, law enforcement agencies. Another incorrect approach, which is to ignore the suspicious activity due to a desire to avoid causing client inconvenience or potential loss of business, represents a severe ethical and regulatory failure. This inaction directly contravenes the employee's duty to report suspicious transactions as required by law and internal policy. It contributes to the risk of money laundering and terrorist financing, undermining the integrity of the financial system and potentially exposing Sberbank to significant legal and reputational damage. This passive stance demonstrates a lack of professional integrity and a failure to uphold the fundamental principles of responsible financial conduct. Professional reasoning process for similar situations should involve a structured approach. First, identify and document the specific facts and behaviors that raise suspicion. Second, consult Sberbank's internal AML/CTF policies and procedures to understand the relevant guidelines and reporting thresholds. Third, escalate the matter to the designated compliance officer or department, providing them with all documented information. Fourth, await further instructions from compliance and refrain from taking independent action that could compromise the investigation or breach confidentiality prematurely. This systematic process ensures that all actions are compliant, ethical, and contribute to the effective prevention of financial crime. Question 20. Market research demonstrates that a new fintech competitor is offering significantly higher interest rates on savings accounts, attracting a substantial portion of Sberbank's retail customer base. A senior manager proposes a rapid, albeit potentially less scrutinized, increase in Sberbank's own savings account interest rates to stem customer attrition, bypassing the standard risk assessment and approval protocols for such significant product adjustments. Which of the following represents the most professionally sound approach to address this market challenge? Option A. Propose a significant reduction in other service fees to offset the perceived disadvantage of lower interest rates, without directly increasing the interest rates on savings accounts. Option B. Immediately implement a substantial increase in savings account interest rates, mirroring the competitor's offer, to retain customers, while initiating a post-implementation review of the associated risks and regulatory compliance. Option C. Focus marketing efforts on highlighting Sberbank's established reputation and security, downplaying the importance of interest rates and assuming customer loyalty will outweigh the competitor's offer. Option D. Initiate a comprehensive review of the competitive landscape, customer behavior, and Sberbank's own financial capacity and risk appetite to develop a strategic response that may include adjusted interest rates, enhanced product offerings, or targeted marketing campaigns, adhering to all internal approval processes. Correct answer is B. Immediately implement a substantial increase in savings account interest rates, mirroring the competitor's offer, to retain customers, while initiating a post-implementation review of the associated risks and regulatory compliance. Explanation. This scenario presents a professional challenge because it requires an individual to balance the immediate financial implications of a decision with the long-term reputational and regulatory consequences. The pressure to achieve short-term targets can often conflict with the need for ethical conduct and adherence to established decision-making frameworks. Careful judgment is required to navigate these competing pressures and ensure that decisions are not only profitable but also compliant and sustainable. The correct approach represents best professional practice because it prioritizes a structured, evidence-based, and ethically sound decision-making process. This involves thoroughly understanding the problem, gathering relevant information, considering all potential impacts, and consulting with appropriate stakeholders. Such a methodical approach minimizes the risk of errors, ensures compliance with Sberbank's internal policies and relevant regulations, which, for this exam, are assumed to be within the Russian Federation's financial regulatory framework, and fosters trust and accountability. It aligns with the principles of responsible financial management and corporate governance, which are paramount in the banking sector. An incorrect approach that focuses solely on immediate profit without considering broader implications is professionally unacceptable. This could lead to regulatory breaches, fines, and damage to Sberbank's reputation. For instance, ignoring potential conflicts of interest or failing to conduct adequate due diligence on a client or transaction could violate Sberbank's internal code of conduct and potentially Russian banking laws concerning risk management and customer protection. Another incorrect approach, such as making a decision based on personal bias or incomplete information, undermines the integrity of the decision-making process and exposes the individual and the institution to significant risks, including legal repercussions and loss of client confidence. Such actions demonstrate a disregard for professional ethics and regulatory requirements. Professionals should employ a decision-making framework that includes clearly defining the problem or opportunity, gathering all relevant factual information, including market data, internal policies, and regulatory requirements, identifying and evaluating alternative courses of action, considering their potential benefits and risks, consulting with relevant experts or supervisors when necessary, making a reasoned decision based on the evaluation, and documenting the decision-making process and the rationale behind the chosen course of action. This structured approach ensures that decisions are well-informed, defensible, and aligned with both business objectives and ethical and regulatory standards.